Venture Capitalists Decoded. Getting the working capital you need to grow your company doesn't have to be too hard. Lots of businesses these days turn to venture capitalists. These options can work for startup ventures, but there are details you should know. What is a venture capitalist? According to Investopedia, a venture capitalist is an investor who either provides capital to startup ventures or supports small companies that wish to expand but do not have access to equities markets. Venture capitalists are willing to invest in such companies because they can earn a massive return on their investments if these companies are a success. How are venture capital firms put together? A fund is created from pooled money. These funds come from the venture capital firm itself, wealthy persons, pension funds, foundations, insurance carriers, and corporate pension funds, etc. All partners have part ownership over the fund. However, the VC firm controls where the fund is invested. Investments are usually into businesses or ventures where most banks or capital markets would consider too risky for an investment. The venture capital firm serves as the general partner. The insurance companies, pension funds, etc. are all limited partners. Venture capital fund managers are paid with management fees and carried interest. Depending on the VC firm, about 20% of the profits go to the company managing the private equity fund, while the rest goes to the limited partners who invested into the fund. General partners usually get an additional 2% fee. While roles will vary, there are usually 3 positions in any given VC firm: associates, principals, and partners. Venture capital firm associates usually have experience in business consulting or finance. They sometimes have a degree in business. Associates often do more analytical work. They analyze business models, industry trends, and subsections. They also work with companies in the firm's portfolio. They start off as junior associates and move up to senior associate positions after a few years. What does a venture principal do? A venture capital firm principal serves as a mid-level professional. They generally serve on the board of portfolio companies. They are often in charge of making sure the companies in the VC firm's portfolio are operating smoothly. They are in charge of identifying investment opportunities for the firm. They also negotiate terms for both acquisition and exit. What does a venture partner do? Venture capital firm principals can become partners. This depends on the returns they generate from the deals they make. Partners are mainly focused on identifying areas or specific businesses for investment. They also approve deals such as investments or exits. Partners sometimes sit on the board of portfolio companies. In general, their role is to represent the VC firm. What are funding stages? Venture funding comes in stages and not all at once. Usually, there are 6 stages. These more or less correspond to the stages of a company's development: seed, startup, growth, Series A, second round, aka Series B, expansion, and bridge. Seed funding represents the earliest round of financing needed to prove a new idea. Funding often comes from angel investors or, lately, equity crowdfunding. Startup funding comes when early-stage firms need funding for their expenses from marketing and product development. Growth, Series A round funding, is for early sales and manufacturing funds. This is typically where VCs enter the picture. Series A is essentially the first institutional round. Here is where most companies will have the most growth. Second round funding is for working capital for early-stage companies which are selling product, but not yet turning a profit. Expansion, also known as mezzanine financing, is expansion money for a newly profitable business. Bridge financing is when a startup seeks funding between full VC rounds. The aim is to raise smaller amounts of money instead of a full round. Usually, the existing investors will participate. VCs usually leave via a secondary sale, an IPO, or an acquisition. What are the differences between angel investors versus venture capitalists? Angels are not quite the same as venture capitalists. An angel investor will typically invest in early-stage or startup companies in exchange for 20 to 25% return on their investment. Angel investors tend to invest less and will also want less control than venture capitalists tend to do. Let's recap for Venture Capitalists Decoded. Venture capital is a fairly new method of investing. VCs invest in startups which they think will turn a profit. They often look for companies and industries they know. They are more amenable to higher risk industries. Usually, they invest more than angels do. Funding comes in well-defined stages. VCs want a piece of the business and often a seat on the board of directors. Contact us today to learn more about Venture Capitalists Decoded.